Thank you for joining me. I'm Juan. Today I want to discuss Tesla. Will Elon Musk split Tesla stocks again? What would be the benefit? I also want to give an honest DCF before the end of the video. So what is a stock split? Well, let's think of a pizza pie. Let's say a pizza pie costs $10 and we cut it up in 4 pieces and each person gets a slice. Each slice is worth $2.50 to give you the total of the pie, which is $10. Now, let's say we cut that same pie in 8 pieces. Now, each slice is worth $1.25 to give you that $10 pie. The value of the pie doesn't change. It's just the amount of slices that change. This is an example. They have, for example, a 2-for-1 split or a 3-for-1 split. So if you have 100 shares, if there's a 2-for-1 split, you're going to have 200 shares. So why do companies do this? Well, it allows them to break existing shares into multiple shares without affecting the market cap. And each investor's stake in the company doesn't change. So if you owed 1% of this company, well, you still owe 1% even after the split. Other reasons that companies do this, it allows them to change the share price, possibly bringing in more volatility. Like we mentioned before, if a stock is worth $10 and you have 1 share, a 2-for-1 split would give you 2 shares at $5 each. So take, for example, August 2020, where Apple did a 4-to-1 stock split. And that basically took their price of $494 per share to $124.81 per share. Now, after that, more people are going to be able to trade Apple because stock shares are cheaper and it's going to bring in more volatility. Companies do this to make their stock more affordable. A lot of times you find that growth companies rather have higher stock prices because it adds value to their stock. And sometimes value stocks, they may utilize this split to attract investors. Stock splits overall are positive, except for reverse stock splits. So reverse is the opposite. A company may do this if they fear being delisted. Let's say you have a company that's trading at 50 cents and they do a 1-to-5 stock split. Now, each of those shares are going to be $2.50. Allowing them to be over the threshold for being delisted. But it's not also being delisted. Some companies, they want to reduce volatility. And this happened in May 2011 with Citigroup. They did a 1-to-10 split. And the reason was to reduce volatility and discourage speculative trading. So their stocks went from $4.52 to $45.12 post split. The market cap didn't change, but the outstanding shares went from 29 billion to 2.9 billion shares. Let's get back to Tesla. In August 2020, they did a 5-for-1 split. Now, after they announced this, the stock rose 81% and then another 41% after the actual split. So my prediction is over the next decade, I firmly believe, according to my DCF, that Tesla's price is going to go up. It's not going to stay below 1,000 and it's going to get more expensive. So there's 2 reasons why Tesla would split. One, they want to make sure that there's enough liquidity in their stock. And the second reason is the 70,757 employees that they have. The majority of these employees are factory workers averaging anywhere from $45,000 to $60,000 a year. Tesla has a plan for these employees and it keeps them motivated, it keeps the morale up, where they're allowed to buy stocks. They have a stock purchasing discount plan, which basically allows them to purchase stocks about every 6 months. And let's just say between the 6 months, Tesla traded between 900 and 1200. It's going to choose the lowest price, then allow them to buy some 15% below the lowest price. So if 900 was the low, then they'll buy the shares at $765, which is 15% below the low. So this is a major incentive to keep those majority of factory workers happy. And if it gets to $2,000, let's just say, and let's say an employee is making $55,000 a year after taxes, let's say $40,000, let's say their check comes out to about $1,500. If they put away 5%, that's $75, 10%, $150. Let's say 15%, $225. So let's just say, I don't think the average person is going to put 15, but let's say the average person puts 10%. So that's $150. So after 6 months, they have about $900. So if the stock is $2,000, they're not able to buy a share. They have to wait like a whole year just to buy one share. Now let's look at some numbers before we look at the DCF. So if we look at their models, they have Model S, X, and 3. And you see here that as of March 2021, they sold 1,000 of the S model, 1,000 X, and 121,000 of the 3. So the 3 is the most consistent. In quarter 2, 1.5 thousand, 4,000 of X, and 126. So you see that their biggest seller is the Model 3. And if you look at the price, the average price of the Model 3 is mid-40s. The average price of the X is 80, and S is 100 to $90,000. So that's their biggest sellers, the 3. They were able to have a vehicle that's affordable, that's competitive, and it's a great vehicle to drive. I think it's coming into a big time buy zone for me, and that's why I'm more and more bullish on this company. One, because the more I read about Tesla, the more I realize that it's such an obvious home run play that in the next decade, this is not going to be trading at $900. It's going to be double that. I think right now, with the overall market issues, this seems like it's filling this previous gap here. It may come down to fill this gap around 913, 909. Anywhere in this zone, to me, it's a buy, even if it drops more after that. You look at management, of course, Elon Musk, he has 17% ownership, and he has Kimball Musk, which is his brother, and his brother's been involved with him in PayPal. He has his own business, and he's been extremely successful in his own right. Let's look at this DCF. This takes into account pretty much everything that Tesla's doing and will do. The final price is $2,073, and it's trading at $936. Now, if they're more successful in any of these categories, of course, this is going to be even higher. But I think this is a conservative DCF. And even with that, there's 122% upside. So let's take a quick look at some of these items on the DCF. So here we have the margin assumptions, and we have Wright's Law learning rate, which basically states as companies become bigger, and they start producing more vehicles, the cost for producing these vehicles becomes cheaper and cheaper. Tesla has definitely proven that. They're making these factories quicker, they're making more vehicles and keeping the price down. So for that, it's a bullish upside for me. If we have the insurance assumptions, they're growing also within the insurance field. They just got authorization in another state to have their insurance. So this is, again, my bullish thesis. I picked 2%, 9%, 13, 21% bullish thesis for percentage of cars sold with insurance 2025. Here we factor in 30,000 miles per year for their ride haul assumption. And there's 2 videos here where Elon says that they're going to have this technology. So we have here the vehicles sold and how much they're going to increase as they build more factories. This is only going to get higher and higher. We have here the Tesla insurance factored in. Then we have the human ride share and the autonomous vehicles and the rates that we put in that are competitive with the Uber rates to kind of give an idea of what the potential revenue is going to be. Total consolidated here, taking into a factor their debt and enterprise value, the market cap, shares outstanding, and we come up with a stock price of $2,073. So this is to me, a home run, slam dunk company. I was bullish before, but just watching more and more videos on it and different people speak on it and doing more research, I'm going to dive deeper and deeper and deeper. I'm going to take a deep dive on Elon, deep dive on the company, and just have a series of videos every week going deeper and deeper in Tesla, just to build my bullish thesis. So that was my video. Thank you for watching. See you on the next video.